If you look at the market that the Qualitas Real Estate Income Fund operates in, it's a $270 billion market. The Australian banks comprise between 85 to 90% participation rates in the commercial real estate debt market. It's a very different number if you move to places like the United Kingdom and the US, where the bank participation rates in the commercial debt market, depending on where you are, is somewhere between 45 to 60%. So Australian banks have very much dominated this part of the market. The regulator and the Royal Commission have certainly put a lot of spotlight on the level of banks' total exposure to property as an asset class. Depending on which particular bank that you're doing an analysis on, what you can find is that more than 50% of the bank's total assets are in the form of property mortgages, which creates a centralised risk for anyone's balance sheet to have that level of exposure. So what the regulator is trying to do is to bring banks' total exposure to property as an asset class down. For every 1% that the banks give up, it opens up $2.7 billion of funding opportunities that are required in the Australian marketplace. So what you find is that groups like ours, alternative lenders, are looking to fill that gap created by banks reducing their participation rate. The Australian market is very different to external markets, overseas markets, by the fact that in overseas markets you've had pension funds, insurers, private equity all participate in debt. It's a very well understood asset class. But due to the dominance of the Australian banks in the total Australian market, it's a relatively new industry in Australia. It's now been going for the last 10 years or so. And if Australia its market becomes similar to those of the United States and the United Kingdom, it has a very long way to go for alternative lenders being seen to be mainstream providers of debt into the property market.